Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. Typically joining me today would be the governor of the great state of real estate in Texas, Mr. Michael Becker, but he is on another due diligence assignment. And we are pleased to have the professor himself, Mr. James Zhang. James, how are you?
I'm doing good, Paul.
So it has been an interesting 2025, and we look forward to kind of talk a little bit today about what we're seeing in what we ended up in 2024, going into 2025, what we've seen in 2025, what we expect in 2026. On the capital markets side, if you know us, we're bankers. And if you want to get a good perspective about what's going on in multifamily investing in real estate, you want to come to Texas to see us. So math is the same, whether it is in North Carolina, Florida, California. But if you're looking to make an investment, we think North Texas is one of the best. And the first step for a lot of investors who want to get into multifamily is they come see us at the Old Capital bus tour. We're going to have that in January. James, tell us a little bit more about the bus tour and what people can expect.
January 16th, we're going to start in the classroom and we're going to go through a little bit of history and also how these deals are put together just from the financing side and from the sort of syndication side. I think is always interesting because this really isn't taught anywhere. You know, like if you call an attorney, the clock's ticking, the meter's running. And so if you sit there and try to have an attorney explain this stuff to you, it might cost you $1,000 or $2,000 and you still might get half the picture. So we spend the morning to go through that. And then we hop on the bus around 11 o'clock and then we'll go around Dallas. And we've had a couple of brokers and a couple of owners reach out to us and say, hey, come buy my property. We'll go buy some of the properties that either are on the market right now or about to be listed early, and potentially some of the deals that we just closed here in the last couple of months. So we obviously look at a lot of properties day in and day out, but just going on a property with 30 or 40 other people, you just notice different things and you talk to different managers and you get a nugget or two at each one of these properties.
With interest rates coming down, it may be a good opportunity to, figure out if multifamily is good for you to start to invest in, to come back into the multifamily yield a little bit greater than, say, the 10-year treasury or greater than what a CD can offer. It may be something for you to take a look at. So RSVP, come see us January 16th. And, we don't so much have a dog in the hunt, as we say in Texas, even though I'm not from Texas. James is from Texas, but we don't have a dog in the hunt, but we certainly do want to have your best interests at heart. And we want to take my 38 years of banking experience to kind of educate you about what has happened in the market, what has happened the last 5 years, 10 years, what happened last week. And we'll give you some real life examples of what's going on, what you should do and what you shouldn't do. So I think that would be interesting if you're thinking about getting into multifamily. All right, let's talk a little bit about end of 24, going into 25. We're at the end of the year, the capital markets for 25, James. What was your take coming into 25, just the beginning of the year? Optimism, pessimism? What was your 2 cents?
I can't remember when we were at NMHC, maybe in 23, we were like, survive the 25 was the theme. And that sort of caught fire and people were like, all right, if we can just sort of make it to 25 and make it through, I think we'll be in good shape. And I just saw a LinkedIn post was like, is everyone still alive here in 25? And for some people, no, they're not here anymore. They have left the building. We have seen a pickup, I would say, this year of lenders saying, well, we're just going to have to take this deal back. And we appreciate you, owning this deal for a couple years, but it just hasn't worked, right? So they might have run out of money from CapEx or interest rate caps or, just did not operate the property well. So we've seen a pickup a little bit more on the foreclosure side that I would say in 25 versus 24. We're starting to see lenders also start to cut more deals with new general partners. In 24, we didn't really see, we saw a lot more extensions. In 25, we saw a lot more modifications to existing loans or new loans given to new buyers. A lot of the deals, they still have bridge loans on them, but they've just been recast for another 3 years or 4 years with new owners. And so I would say those two changes I've seen a lot more. But the best thing about multifamily, and sometimes you don't realize this unless you've tried to finance other product types, like we're trying to finance a retail deal right now and some other, we've done some self-storage deals this year. You don't realize how good Fannie and Freddie are.
You bet.
And yeah, Fannie and Freddie, yes, it takes a little bit longer. Yes, they're going to ask you more questions. Yes, all that type of stuff. But at the end of the day, the rate is 5% and it's non-recourse and it's 30-year amortization with 2 to 3, 4 years of interest only. So we've seen Fannie and Freddie just, I haven't seen an official number for 25, but they hit their 73 billion, let's say, for Fannie and Freddie each, hit their caps this year most likely. So all that money got out the door and we saw a lot of 5-year, 7-year paper get done. And next year they get an extra 15 billion each. So they're both at 88 billion next year. That is a huge benefit for multifamily investors out there.
James is absolutely correct when it comes to the different food types in commercial real estate. You have the self-storage, you have the retail, you have office, you name whatever you're driving down the street, grocery stores, you're seeing everything that's part of the commercial side. And multifamily, just like your home loan, that's pretty much either done by Fannie Mae or Freddie Mac because they offer the full faith and credit of the United States to give you the lowest rate possible. Well, that's the same is true with multifamily. So just larger transactions than your house or your home loan, but whether it is a $20 or $25 million apartment loan, it's financed by Fannie Mae and Freddie Mac, and they're based by the full faith of the U.S. government to get you the lowest interest rate possible. That's not the way for retail or office. You either have to do bank loans, which are not backed by the full faith, or you have to do CMBS, commercial mortgage-backed securities. And they ask on a retail deal, is there any shops in there that in the retail stores that sell marijuana? Because if you have a smoke shop in there and you're selling something illegal, we can't have that. So, there's different loans for different product types, and we pretty much have them all. But Fannie Mae and Freddie Mac are probably the easiest ones to get through. And once you get a 30-year amortized or a 35-year amortized Fannie Mae loan, it's difficult to move out of there. But James, I don't want to, say all these loans are bad. I'm just saying that maybe some of the loans, like in the last 3 years, that were taken out by bridge lenders have some challenges. But if you did a Fannie Mae or Freddie Mac loan back 5 years ago, 6 years ago, you're pretty damn happy. Would you agree?
Yeah, you're happy. You haven't had to do a capital call most likely. You haven't had to buy an interest rate cap, but you hated yourself for 2 years because if you put on a loan in, let's say, 18 or 19, and you saw these prices go up, it was difficult for you to sell because you had a prepayment penalty, right? But what we've seen now is some of these deals have definitely come to market where owners have owned them for 15, 16, since 15 or 16 or 17 or 18. And most of these deals, when you go out to LPs and you say, hey, we're going to hold this deal 5 years. Now you've held it 7 or 8 years. They're like, well, when are you getting my money back? Some of these guys have started to recycle capital. So I think in January, we're going to see sort of two types of deals come out. One is, the stabilized deal where their basis was good and they don't have to quote unquote sell, but they want to return capital to their investors at a good number. So those deals will go and they'll be agency financed. And then we'll see other deals where the lender took it back this year and now here's your chance to come in and buy a deal at a good basis, but it might need a bridge loan or it might need a bridge loan from the existing sort of seller financing deal. But the other piece that I wanted to talk about that has really impacted more the BNC space is really just the amount of transactions that have happened on the A side versus the BNC side. So a lot of, let's say 100 deals got done in Dallas, Fort Worth. A ton of those deals were A deals. And so if you look at the volume, the last chart I saw for Dallas, I think Dallas still did a big number this year. in terms of new transactions, but 60, 70, 80% probably closer to 70 or 80% were probably Class A deals.
Can you
On the
define what a
acquisition side.
Class A deal is for somebody that maybe is not familiar with the terminology?
Class A deal is probably less than 25 years old. So I'm going to use the cutoff at 2000. Not that many deals were built in the 90s, but let's say 2000s and newer. So you've got, 9-foot ceilings, you've got garages, you've got sprinkler systems, you've got the nice sort of pool, you've got stainless steel appliances, all that type of stuff. It's not brand new, but anything 2000s and newer, I would say, is what has been trading. And the BNC stuff, the reason it hasn't been trading is a couple things. One is just cap rates have expanded further than the A ones, right? So if everything was a 4.5 cap in 21, 22, if A's have gone to 5, B's have gone to 6, and C's have gone to 7, all of a sudden now that price point that you need to sell at, just it's not feasible right now. A lot of the BNC deals just have not traded in the past couple years.
So you're the two of us, you're the smarter one. So a lot of people ask us, Paul, where are rates going? So I'm going to ask the smartest guy in the room right here, where are rates going? And I guess you have to define them by short-term and long-term rates for 2026.
Yeah, I mean, I think the Fed came out and just was sort of like maybe one, maybe two cuts. I mean, they've already given us a couple cuts this year. The short-term rate doesn't impact you as much unless you're on a floating deal or you're buying an interest rate cap. But the long-term piece, so the 5, 7, 10-year treasury is what really impacts you. And a lot of those deals, I mean, we did a ton of deals sort of 2015 to 2019 on agency, and almost all of them were 4.5 to 5.5% fixed rate for probably 10 to 12 years. And that's essentially, we're a little bit higher than that, but not much. It does feel, people feel like the rates are high right now, but nobody's expecting them to move that much. And when rates did drop below 5 for a little bit here this year, Fannie and Freddie got full real quick. So everybody was running to that gate. As soon as, you saw a 4 handle on the interest rate, everybody was refinancing, everybody was buying, because that seems to be the trigger where a lot of these deals can sell.
The biggest thing that I'm seeing really is, and I saw this in the Yardi Matrix piece, which I thought was funny, talking about the amount of demand versus supply in some of these states. They were talking about there's a lack of housing in California, whether it's rental units like an apartment or it's a house. They're 840,000 units short. In Texas, we're 320,000 units or houses short. In Florida, 244. In Illinois, 153,000. And there's 138,000 in the state of Washington. It seems like we're building a bunch of apartments and inventory here in Texas, but it still, by these numbers, says that we're pretty short. What's your take right now on supply versus demand, at least up in North Texas, James?
I think the scariest chart somebody showed me was really sort of how many units were delivered or about to deliver in sort of North Dallas, I would say in the, let's say, Plano, Frisco, McKinney, Allen area. So just go straight north up the tollway or up 75. So the supply that's hit, it is in certain pockets, right? So it's usually the suburbs that get hit. And I think a lot of the urban development hit first, and then now it's all the suburban that is hit. But the price point on those units are pretty high, right? I think the thing to think about with all this supply is that those guys are giving, let's say, a month to 2 months free, and that's impacting your Class B guy. And the problem with some of these C deals also is that when these banks foreclose and their basis is reset, or a new buyer comes in, the basis is reset, they're going to drop their prices. You're sort of getting hit on both sides of it right now in terms of the new supply that's delivering and leasing up, and then also from, you can't really find a floor, right, in terms of your basis. I think there is demand, but how much people are willing to spend, I think I was talking with one property manager, and we're like, when are we going to be able to burn off these concessions? And they said, look, the first thing that the client asks or the tenant asks when they walk in the door is, how many months free am I getting? Like, they're not asking about the gym. They're not asking
Mhm.
about how many lounges are at the pool. They're asking, what am I getting for a deal here?
Well, what did your sister down in Austin? What kind of a deal did she get?
Yeah, I mean, so she lives up in sort of northwest Austin and, near the Domain at a brand new property. And when she signed the lease last year, she got 10 weeks free. And then she went to renewal and they're like, "Oh, we can give you 5." And she's like, does this sound right, James?" I'm like, "Let me run it." And almost everybody was given 10 weeks free. So I just said, "Hey, send him a note and say, hey, here's a couple comps from my brother that got we should get 10 weeks free." And they hummed and hawed for a little bit, and then probably 15 days before the renewal was up, they caved and dropped it to 10 weeks. And this was in October, and then I saw her in Houston over Thanksgiving, and she's like, "James, you can't believe it. You're not gonna believe this. Now they're giving 12 weeks free." I'm like, "Oh my goodness. We're not moving in the right direction quite yet in terms of burning off this concession." So, a lot of these developers, you pro forma, once you lease it up, once you get to 90%, then you can just roll these concessions off and everyone renews at their market rent and we sell this deal. But if you're having to battle through other properties that are giving, 1 or 2 months free, it is hard to keep the back door closed on these deals. And so your renewal percentage keeps dropping and you have to keep giving concessions. So it's just taking a little bit longer. So we're looking at multiple deals, sort of taking the construction lender out and bringing on maybe a 3-year bridge. And there's a lot of money, I think, in that space right now. Not as many people doing the 10 to 15 door rehab on a BNC property. More people are doing the bridge loan to the burn off concession, no rehab budget, value add plan right now.
So between us girls, so to speak, where are you putting your money at? Are you still buying multifamily properties? And what type of properties are you buying? What is your personal advice? Because everybody wants to know what we're doing with our money. Tell us a little bit about what you think.
Usually A and B properties, probably 200 units and up, where you've got a little bit of runway. So I would say 5 and 7 year at a minimum on agency. So you got to qualify for agency. So that's check one, right? So if you say there's two types of deals out there, one is the stabilized deal, and the other one is the broken deal, but at a better basis. I'm just more conservative, so I'm more on the deal number one, where it just qualifies for agency. And then, we might be in this for a little bit, right? And so it is hard to time the market. So I think that's what is hitting people on bridge loans is that this downturn has been a little bit deeper than people expected and longer. It's just taken more time to get through it. That's why I like maybe a 7 year, agency on an acquisition. And then on a lot of the refinances that we've done, it's been 5 year money. So I think if you do that, the deal qualifies, you have good economies of scale, 200 units and more, and you've got a good operator that's local and has done this, more than once, then I think you're in good position. And give us a call if you're looking at a deal though, because we seem to be getting more calls like that these days. Is just sort of like, what do you think of this deal?
Or what do you think about this area? What do you think about this sponsor? What do you think about this? What do you think about that? And that's what I really enjoy about what we do because, I mean, we're Switzerland, as you know. We're not affiliated with an investment sales group. So we have an independent voice that you want to listen to. And if you're new to multifamily or just new to commercial real estate, you do want to spend some time with someone from the old capital team who's, we do one out of every 3 apartment loans in the Dallas Fort Worth area of Austin and San Antonio. So we're we're very active in this space. And so we kind of know what's going on. And you want to get just our back of the napkin feel about what we're seeing out there. We talk a little bit about the investment sales people, James. I mean, you've talked with a bunch of them recently. We have our biweekly calls with every investment sales team in the Dallas Fort Worth, Austin, San Antonio markets to kind of figure out what's going on. They get on the phone with us and we go through it for a half hour, 45 minutes about what we're seeing and what they're seeing. Some great synergy on that. Tell me a little bit about what you're seeing of what some of the brokers are talking about these days.
Yeah, I mean it's not easy to be a listing broker right now. right? Because it is tough. There's not as many transactions, so it's hard to pinpoint the exact value to go out at. And then some brokers have less deals on their plate. And so they're just sort of quote unquote buying listings by saying, of course we can get you $10 million. And then they list it and it comes back at 8 million, right? So it's just it's a little bit of an oversell. I want to say probably half the deals listed this year probably didn't trade. And the reason that they didn't trade was the pricing expectation set by the broker didn't hit reality. So they took it out at 10 million and all the bids came in 10, 15% lower than that. So that's one. And then number two is the person got under contract, collections might have fallen off, the debt wasn't there, or maybe was there on agency, but then they couldn't raise the equity. So I think that's the piece of it that, in the 10 years I've been doing multifamily, it's probably the hardest to raise equity right now. And that's where people are running into. And that's why there are $50 million deals still getting done, but it's pretty rare. And most of that's institutional money buying Class A deals. But in the BNC space, I would say the most active is probably in that 10 to $20 million or even under $10 million space where it's sort of one check writer. And, when we talk to investors, like I talked to an investor out of California and, I was walking them through a deal and I'm like, at the end of it, I'm like, if you don't want to do this deal, that's fine. Like there'll be another deal. Don't worry about it. And they're like, we've never heard that from a broker. It's like, well, I don't care if you do the deal or not, but don't make it seem, I guess what the right word is, like, we would rather you keep your money and not lose your money on this deal. So we're not going to push you into any deal just to make our fee on the deal. So I think that's what sort of sets us apart from a lot of brokers where they're just like jamming any deal down people's throat. So
It's amazing what a couple of years has done to the investment sales brokers that are out there. I don't look at Instagram very much, but every once in a while I'll look at it and there's a meme, and I guess that's what you call it, of Matthew McConaughey. And I'm sure that you've seen it where there's a meme on the top of Matthew loving life, big smile. He's doing everything that he can do. And it says 2021. And then there's another picture of Matthew McConaughey through the Dallas Buyers Club where he's driving down. He's terribly gaunt and he's crying in front of the wheel of the car. And that says 2025. And I think that is an indication of the dynamic between what it was 3 years ago. Everyone was happy and smiles versus the investment sales today. They're all crying or they're looking to go do something else. And so I'm collecting money, James, for some investment salespeople that may have not had a good Christmas. Maybe we could put some money aside for a fund for some of the investment salespeople.
as you've always told me, Paul, always put something aside here.
Save your money.
Save your money in the good times so that you can survive the bad times, right? So
100%. Any final words of wisdom going into 2026 and finishing up 2025 in the capital markets, James?
I mean, it's almost like the best operators right now are really shining. So the people who understand leasing, understand management, you're having to hold these deals longer. So it's not a 2-year flip and I'm out of here and I'm doubling everybody's money. You're having to hold these deals 5, 6, 7 years. Being prepared for that, being capitalized for that, having the team in place, I think is what is really shining. I think at the next year, we're going to have some guys who just are going to give up and they're going to just, it's time to go. We didn't capitalize the deal. We don't have the operational strength. And so I think it's a moment in time now for people to step in and buy at a pretty good basis on these deals. But you've got to make sure you've got the money because somebody on a recent LinkedIn post that I put up there, he stepped in 2009. And for 3 years, he fed the deal out of his own pocket because he didn't raise enough money. He thought he had enough money, but he didn't raise enough money for the interest burn and the CapEx and for the market to heal, right? And so I don't know if it's 2009 or 2012 right now, but you've got to make it to 2015. So I would say 3 years at a minimum. maybe 5 years on the 5 or 6 years. So make sure you've got enough money. Make sure you've got enough runway on your debt to get there, though.
Absolutely. One more time, come see us in Texas, make a reservation. It's a nominal cost to come see us for the bus tour. Again, one more time, James, what's the best way for people to get RSVP
Just go
and
to
tickets?
oldcapitalpodcast.com or find us on LinkedIn or Facebook or wherever you find us and track us down. But you can register right there. And so it's January 16th.
January 16th. Come see us. Again, the professor, thank you very much. Appreciate it. Have a great Christmas and New Year's. And to everybody, thanks for listening again this year. I mean, we have thousands and thousands and thousands of downloads. We certainly do appreciate that. We appreciate when you come up to some of these events and meetings. You say that you're a big listener of the podcast. Michael Becker, James Eng, and myself certainly do appreciate you saying those kind words. And again, have a great 2026. I'm Paul Peebles. Good day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.